Anticipated financial crisis of 2025, a comparative analysis with the 2008 meltdown. In recent times, financial experts have voiced concerns about a potential global financial crisis in 2025, possibly surpassing the severity of the 2008 meltdown. George Gammon, a renowned investor and macroeconomics educator, has been particularly vocal about this impending crisis. In his video titled 2025 Crash Will Be Worse Than 2008, Gammon delves into the indicators and factors that could lead to such a catastrophic event. Early warning indicators. One of the primary metrics Gammon highlights is the near-term forward spread, a tool utilized by the Federal Reserve to forecast economic downturns. This spread measures the difference between short-term and long-term interest rates. An inversion, where short-term rates exceed long-term ones, often signals an upcoming recession. Currently, this spread is more inverted than it was prior to the 2008 financial crisis, suggesting a heightened risk of a severe economic downturn. Impact on the general population. The financial strain on everyday Americans is becoming increasingly evident. A significant portion of the population is resorting to borrowing to meet basic necessities. A recent survey revealed that 21% of respondents have used buy now, pay later services to purchase groceries, with 44% anticipating the need to do so in the next 6 months. This trend underscores the escalating financial pressures faced by many households. Banking sector vulnerabilities. The stability of the banking sector is also under scrutiny. In 2023, the total assets of failed banks reached approximately $600 billion, surpassing the inflation-adjusted figures from 2008, which stood at $500 billion. This alarming statistic raises concerns about the resilience of financial institutions in the face of potential economic shocks. Real estate and stock market overvaluations. Both the housing and stock markets exhibit signs of overvaluation. The price-to-income ratio for homes has exceeded the peaks observed during the 2008 housing bubble. Additionally, valuation metrics such as the Shiller PE ratio and the Buffett indicator are at historically high levels, indicating that stocks may be significantly overvalued. These indicators suggest that both markets are vulnerable to substantial corrections. Unemployment rates and economic cycles. While the current unemployment rate hovers around 3.5%, historical patterns reveal that recessions often commence when unemployment is at its lowest. As the yield curve inversion persists, there's a growing concern that unemployment could rise sharply, leading to a more pronounced economic contraction. Conclusion. The convergence of these warning signs, an inverted yield curve, increased reliance on consumer debt for essentials, banking sector instability, and overvalued asset markets paints a concerning picture for the global economy. If these trends continue unchecked, the anticipated financial crisis of 2025 could indeed be more devastating than that of 2008. It is imperative for policymakers, financial institutions, and individuals to heed these warnings and implement strategies to mitigate the potential fallout. Note, the insights presented in this analysis are derived from various sources and reflect the perspectives of financial experts. Readers are encouraged to consult multiple sources and seek professional financial advice when making economic decisions.